All right, we are live. Let me know in the chat whether you can hear and see me all right. I want to make sure everything is working. What's up, Nicola? All right. I have gotten closer to being able to use OBS for these streams. I almost was able to go live with it this time. Um, the uh, the issue that I ran into this time right before I went live is in order for me to see the chat in there, it was making me sign in again. Well, the problem with that is my two-factor authentication makes me use my phone to do a login. And the problem with that is I use my phone as my webcam. And if I uh, shut the webcam feature off from my phone in order to do the two-factor authentication, then it takes like multiple shut down, turn on, shut down, reconnect attempts in order to get my iPhone to work again as the webcam. And so uh we'll get it next time. I'm getting closer every day though. All right. Hello from Lebanon. Yeah, well, good to see you from Lebanon here. Thanks for joining. Let me know. I'm curious. Let me know about the how things have been. I know for uh the last, I don't know, at least 5 years, it's been absolutely just one thing after another there in Lebanon. Oh, you said Lebanon MO, so maybe you're not, maybe you mean Lebanon, Missouri there. I was thinking that I do have a friend in Lebanon, and I know for the last couple of years, it's just been, absolute, nightmare there, one thing after another, whether it's war or hyperinflation or, shortages and rations and everything like that. So, um, but now that I'm looking back at your comment, it looks like Lebanon, Missouri. So, okay, a couple of things going on. Number one, we got crazy jobs reports. We've got recession indicators. We've got all sorts of stuff. And it seems like, as always, markets are climbing a wall of worry. So we'll see. The results of today's jobs report are not. I mean, it's not. Let me pull it up here. Where is it? Okay. All right. So every time you see these numbers, number one, you always have to ask, are these seasonally adjusted? Because seasonal adjustments can either mask something extreme or they can make something look extreme that actually wasn't. Now, the reason why they do seasonal adjustment is because when you look at most data sets where it's common to use seasonal adjustment, is because the data set has like a natural rhythm to it where during certain periods of time, the numbers are usually naturally higher, and other periods of time, the numbers are usually naturally lower. And so they do seasonal adjustment to compensate for that so that you can get a better idea of the real change. That the problem with that is that that works best when you look at it over long periods of time because that smooths the data out. And then you get these wild changes. And so in let's see, let's go, let's try and share the screen. Hopefully it doesn't crash out on us. We'll try it. There, which accounted for more than 70% of the total net increase. The other thing, I don't know if it was in there. By the way, guys, throw in the chat if that glitched out. Sometimes when I do the screen share, it glitches out. So if that glitched out, I will not screen share again during this stream. If so, the one of the things that that just happened, I just posted about this on Twitter. If you follow me on Twitter, you probably already saw it. If you don't and you're on Twitter or X, I'm pretty active there. But anyway, so the federal full-time employees is now at the lowest level it's been since March of 2015, which is fantastic. I mean, that's a really, really good progress. We're nowhere near where that number should be. But I mean, erase and by the way, the number of federal employees stays within a very tight range. It's been 2 to 3 million for decades, and so we're down to 2015 levels. It's not anything insane, but the big problem is contractors because that's like at least 5 million people. And so, the money the government spends is still the money the government spends, whether they're paying it to a contractor, whether they're paying it to a full-time employee. So, but it's still progress nonetheless. It's just not as big of a deal as a lot of people think it is. So, um, jobs numbers again are fairly mixed in terms of unemployment going up. Job gains in some areas. Number of people holding multiple jobs is at a record, or at least a recent record. So we do have conflicting jobs numbers. But no, I do not think that this is indicative of like just by itself a recession right around the corner, um, or a recession happening right now. When is the best time to refinance a mortgage? It's when the break even is less than, I would say I would say as close as like to a year. If you can get it under 2 years, it's probably okay. But whenever you do a refinance, it's gonna cost you money to do the refinance. So then you say, okay, well, if my payment is going down by $200 a month, but it's taking, it's going to cost $10,000 to do the refinance. Well, then 10,000 divided by what did I say? Did I say $200 a month? So 10,000 divided by 200 is 50 months. So 50 divided by 12, you're looking at a little over 4 years. And to be honest, a lot of the refinances that a lot of people are looking at right now, the break even is like 10 to 15 years down the road. It's just not anywhere near close to worth it. But if you can break even, and basically the monthly savings that you have from refinancing um, equals the cost of your of doing the refinance within like a year, then that's great, because then everything after that is just money in your pocket. Okay. What is your prediction for the lowest 30-year rate over the next 10 years? I'm saying 5%. The lowest 30-year rate over the next 10 years, assuming we don't get any sort of yield curve control or solid, like real QE, um, then yeah, I think it's going a lot higher. The problem is what the government wants to do, and which is why they're refinancing at the short end so much right now, is because they're trying to get all of as much of their debt as possible ready to refinance into longer debt. Um, and then once the time is right, whether it's through bank deregulation or decreasing interest paid on reserve balances at the Fed, whatever the method is, they're going to try and get a ton of money going into those long-term bonds through the banking system to push those rates lower so that they can roll it all out. Um, Now, the thing though is, if they're able to accomplish that, that pushes yields down. And so it is definitely possible that we see the 30-year go down in the next couple of years as they try and get that plan to unfold. I would not be surprised to see some big action on that in 2026, um, in terms of bank deregulation to get banks to be able to buy an unlimited number of treasuries. Right now, they're limited with how many treasuries they can buy based on the supplementary leverage ratio, and they've already tested getting rid of that. They suspended that during 2020 and 2021, um, and so people like Stephen Moran have been pushing the idea that we need to just permanently get rid of that, let banks hold as many treasuries as they want, because they're basically fungible with reserves. And so when you consider things like the Bank Term Funding Program, where banks can sell treasuries back to the Fed at full price if they're underwater on them temporarily, there's no risk. So uh, allowing banks to do that would open the floodgates for the government to be able to borrow basically an unlimited amount at the long end, and banks would be there to you know to lend have an unlimited appetite there. All right, let's see. Next question. How do you hide your mic but still make it sound good in your YouTube videos? Also, do you make a script to memorize it, or are you reading somehow? So let me move my camera so you can see. That's the setup where I'm looking when I'm actually recording my YouTube videos. And so you can see right up here, that's my microphone. So it's just the Shure SM7B. It's a decent microphone, but it's very, very, very popular. It's what you see on all the podcasting um videos and stuff. Very popular. You need to pair it with a couple of things. Number one, you need to pair it with a Focusrite Scarlett. That's an audio interface. And in between the microphone and that audio interface, you need it's called a cloud lifter. And then you have those. You plug the Focusrite Scarlett into your computer, so that your computer can pull that audio in, the digital file for that audio, and it'll just be very, very quiet. And when you're in editing, my editor does this for me, but when you're editing it, they can pull the volume up. So the audio will be best if you can have the microphone close to your face, but obviously it's not necessary. Now, for that setup, there are better microphones. I just haven't gotten around to swapping it out because it's kind of unnecessary. So something like a Sennheiser, oh man, I can't remember the name, but they're like like a boom microphone. It's like really long, really skinny. And so having one or two of those set up and angled at you would be a better setup for that distance. But I mean, this works out fine. And I do not make a script. I've never made a script. The closest I ever come is if I am talking about something in a YouTube video that I'm not super familiar with off the top of my head, I will make an outline, and then I will look at my next bullet point, and then I'll talk about that. Then I'll look at my next bullet point, then I'll talk about that. So I'll make an outline. But a lot of times I've just done this so many times it's not necessary. But I definitely am not saying that as if it's prescriptive. If you want to make YouTube videos, do whatever is necessary in order, like do what is required for you, do whatever it takes. If you need to script it out, that's fine. Just don't have something like any chat GPT or anything write your script for you, because at this point it's still very easily recognizable if AI writes your script for you. If you don't do any changes or editing to it. And even if people can't articulate why they don't like the way you're talking, they will subconsciously not like it, and it will hurt your views because you're basically reading something that somebody else wrote for you, rather than being authentic. So I would say as much as possible, especially because it forces you to actually do real good thinking. Like you might think you have a good thought that you can talk about, and then once you start trying to actually talk about it, you realize that your clarity on the topic is nowhere near where it needs to be. And so by forcing yourself to go through the process of writing out what you're thinking, you realize all the holes in your thoughts and what you need to clarify first, and then you can talk about it. So I would definitely encourage you to do the writing. Because if you don't, it'll just be a much longer period of time before your ability to just speak on the topic is good enough to gain real views and real traction. So it's still possible. I just say you're probably going to speed run there if you practice writing out your script first, even if you don't use the script to read during the video. All right. Do you expect the interest rates to continue to fall? Do you believe the Federal Reserve might be shut down by the president? No, the Fed will not be shut down by the president, but more and more control over it looks to be being taken by the executive branch. And that's just through the people who are being put in positions of power there. But at the end of the day, it is Congress who decides what the Federal Reserve does. Now, Congress has a very long track record of abdicating their responsibility to executive branch agencies. So I would not be surprised at all to see Congress take zero action at all. if the executive branch underneath the Treasury tries to do more tight coordination and more exert more control over the Fed. So I do think we'll see more and more coordination and more executive branch control over the Fed, but it won't be anything like abolishing it or rewriting the Federal Reserve Amendment Act of 1977 or anything like that. Okay. All right. Yep. I won't share screen again because it always glitches out. The Bitcoin Onion, $20 super chat. Thank you for that. I really appreciate that. Very nice of you. Are you aware of Bitcoin infrastructure risk? Bitcoin needs the price to double every 4 years for eternity because the halvings. This is because Bitcoin has no free market after 15 years. Bitcoin ability to double prices gets harder at $2 trillion market cap. Um, I don't I don't think that is a true statement that Bitcoin needs to double due to the halvings. Because the halvings are just how much Bitcoin is released to the miners as payment for mining. Once we get to the point where that ends, I think in the year 2156 or whatever, then it would transition to a fee-based approach where fees are paid to the miners rather than just relying on the Bitcoin being, unreleased Bitcoin being released. I don't know of any reason why you would need the Bitcoin price to double along that path every single 4 years. Um, now with just natural deflation, like if Bitcoin is used as universal money, natural deflation means that well, the price doesn't double then because prices are denominated in Bitcoin, but it means prices of other things priced in Bitcoin continue to go down. And that's what happened to everything throughout all of human history when gold was money. Just the price of everything, wages, assets, goods, services, luxury, everything just slowly trickle down over time. All right. If Bitcoin gets to a point where it can't double in price, the security drops, the cost to commit fraud gets cheaper. I again, I don't understand what the connection is there that you're saying. And so, like, somebody who is a lot more educated in Bitcoin than I am, might be able to have a little bit more of an educated commentary on this. I don't see the connection that you're drawing there. Maybe it's just I'm misunderstanding what you're saying. Um, because regardless of what the price does, it's the difficulty of doing the calculations that um, that continues to keep miners mining. And if there's not enough of them doing that, then it'll get it'll get easier and easier in order to attract less computing power and more people to do it. So I don't see how that has anything to do with the price. Okay. What do you think about the persistent low oil price, and do you think that helps out businesses? Over the long term, yes. I mean, in the short term, severe drops in oil are recession signals. Um, but they're like it's a good chunk of the drop in oil prices has been to the current um, political environment, and so a good chunk of that is is being done on purpose in order to lower energy costs. Because if you have lower energy costs, that contributes to economic growth across the board because it's everything is cheaper. Um, but there is also a good chunk of the oil price dropping that is a signal of lack of growth. Do you think the dollar will be put back on the gold standard? No, I do not. Uh, no government throughout history has ever voluntarily done that. It's always been done at basically because the people will no longer accept payment in the fiat currency unless it is redeemable for gold. And it's because the people are already using gold for payment. So I don't think that that will happen voluntarily. It would only happen if the dollar is just no longer accepted as payment. I think getting to that is a lot farther away than people think. Definitely not something within a matter of years, maybe decades. What's your opinion about DXY? What's the next move? I am bullish on the dollar index, DXY, dollar versus other currencies. I don't have a time frame on that. Short term, definitely no time frame or no short term opinion. I would say 1 to 3 years. I'm definitely bullish on the dollar compared to other currencies, not compared to things like gold or real estate or stocks or goods or services. Hiding the Christmas present under your debt. Yeah, those are actually not my kids. My wife is the one who has who takes care of all the kids' presents, and most of those are already under the tree. But those are my wife's, and so um, I had to find a place to hide them from her. So um, yeah, those are Christmas presents. All right. Are you aware of the node issue? The Bitcoin core devs are compromised. The Core 30 upgrade allows spam, which could include CSAM. We are working on a fix and we'll be soft forking soon. Get ready. Yes, I'm okay. You guys are pushing me past my knowledge of Bitcoin here with some of these questions and comments. I am aware of it in the sense that I know that people are talking about it. I am not aware of it in the sense that I understand what people are talking about. And so I know that there is an issue that people are working on, and I understand that like there's another side to this debate too, where uh, they that people are saying no, it's that Bitcoin core devs are not compromised. So, but yeah, I don't have any really uh, educated comment to reply to that about. Thanks for answering the questions. Love the channel. Well, I appreciate it. I'm sorry I couldn't. I didn't have a better better answer for your question. All right, thoughts on why we haven't heard updates on the Fort Knox gold audit? Probably the same reason why we haven't seen a complete release of the Shepstein files. Probably the same reason why we saw no decrease in government spending, why we saw no decrease in taxes, why there's been no significant deregulation for businesses. I mean, basically, it's like everything that people were expecting and wanted. It's like, okay, well, nah, we're just gonna do our own thing now. Um, and I think the Fort Knox gold audit fits cleanly in that category. Can you take a look at Maxi? I'm dumping Misty for Maxi. Dumping Misty is probably something that is well advised. Maxi being used to replace it is probably something that is ill advised. So let me take a look. What is Maxi? MAXI. Simplified Bitcoin strategy plus, let's see, it is long exposure Bitcoin futures, collateral management via short-term debt securities, and income generation through active option overlay strategies. All right. If I was giving advice to myself, because I don't know you, I don't know your financial situation, so I can't tell you what to do. If I was talking to myself, I would say, stay away, don't touch it with a 10-foot pole. The reason why is because there are two legitimate ways to produce income when you're talking about securities, like assets, like stocks or investments. One is through business profits. So if I have a business, if I own shares of a company and that business is profitable And me as a shareholder, a part owner, I want to take advantage of some of those profits. I'll say, hey, let's take some of those profits and pay them out to all of the owners as some income. That's called a dividend. Um, and that is a legitimate, sustainable, attractive business strategy, is to pay income from excess profits to owners as a dividend. That's one way. The second way to generate income is through lending. So I have some extra money that's sitting in a bank account, and I don't want to earn, the 1%, 2% maybe that's coming from the bank. And so I go to somebody who is looking to renovate a house, or build a house on a property, or, some real estate thing. And I'm like, all right, well, it's going to take you 8 months to do that. I'll give you a hard money loan. Here's 100 grand. You pay me, 12% interest, just one lump sum in 1 year. And that is income that is produced from lending, from interest on a loan. That is legitimate as well. And the person who takes that loan is going to use that money. And even after the income that they have to pay to me as payment for being able to use my capital instead of theirs, they're going to do something that they're going to be able to turn their, take their money, their contribution into that project, and their cash on cash return is going to more than compensate them, even after that interest. So lending. Oh, what's up, Johnny Bravo? How you doing, man? Thanks for the super chat. I'll have to stop by and send it back. All right. So lending, you get interest. That's a legitimate way to earn income in terms of assets and investing. Now, there's a third category that is confusing a lot of people, and that is all of these ETFs out there that say that they're high income funds. They say that they're paying out dividends. They're not dividends. There's no lending going on, and there's no legitimate business producing excess profits. The way these funds produce income is through selling covered calls or cash secured equity puts on the underlying security. Now, there's nothing inherently wrong with that. In fact, it's a strategy that I use myself, and that I think if you know how to do it properly, it's very easy to earn good income yourself doing strategies like that. The problem is these funds, the way ETFs operate is, even active funds, they have to stick with a very, very strict schedule of what they invest in, how much they allocate to the particular securities, and how they choose them, which means they can't have a dynamically adjusting strategy given the market conditions, which means, like for me, if I want to generate income through selling calls and selling puts on, a stock like Apple, on days or weeks or months where the Apple stock price is running up, I will sell calls because that's a good time to do it. Calls, premiums are going up, so I'm able to capitalize on that. If I end up losing the shares, that's okay because I end up selling them at a gain. Once I don't have the shares anymore, I'm going to start selling puts on that. But I'm not going to do it while the stock is running up. I'm going to wait for the stock to drop. I'm going to do it on red days or red weeks or red months. And then I will sell puts once it's worth it to sell those puts because there's premium there. And if I then get assigned and I get the shares, I'm okay because I bought them at a price I was willing to buy those shares at based on the strikes that I chose. And I'll flip flop back and forth. But the key is I'm doing it dynamically, adjusting to what the market gives me. I'm not forcing myself into a trade just because I have to. All of these ETFs have to keep on trading, which means oftentimes they're losing the shares at a loss because they have to keep on selling calls, even if they're selling them under the cost of the shares. So the stock drops, who cares? They have to sell more calls. So over time, even if you adjust for the income they're producing, every single one of these funds underperforms relative to the underlying. So if you overlay Maxi or Misty on top of MicroStrategy and you adjust for the dividend income, so you look at total return, it will always underperform because they lose the shares at a loss. The income that they make doesn't compensate for it. And even when they lose the shares at a gain, it's nowhere near the gains overall over the long term that the underlying shares have. So I never, ever, ever touch any of these structured income products that use option strategies because they cannot adjust dynamically. And so they are forced into rolling over the exact same strategy and they always underperform compared to the underlying. So if you like the strategy, you like the income, just learn how to do it yourself. That way you're not forced into rolling it over at bad times and bad prices. All right. Let's see. I love the Muhammad Ali picture in your videos. What do you do to stay in shape? Okay, so this picture on my wall that's behind my in background on my YouTube videos. It's actually not Muhammad Ali. I've done a whole video about the story, so I won't go into it super in detail. But basically, when I first started my business, it took me a year and a half before I was able to make enough money to pay the bills. It took me a long time to figure out how to monetize through with starting a YouTube channel and everything. So during that time, obviously, we were keeping spending tight, keeping budgeting locked down, and I saw that on a wall in a used furniture store. Saw that picture, and immediately I was like, "Oh man, that is it." Just like sometimes you see something, it just kind of like sticks out to you. And for me, it was because like the speech by Teddy Roosevelt has always kind of hit home with me. The man in the arena, it's not the critic who counts. It's the man who's actually in the arena. And I really felt that during that time because there's really no glory or no honor. There's no feeling of nobility. There's no nobody cheering you along when you're doing the work by yourself. When before you've started to see any sort of success, and you're just alone in the arena, but you're by yourself. And so I saw this picture, and it's just a random boxer. It's not Muhammad Ali. It's just a random person's photographer's portrait. And I don't know if you can tell there, but the lights are off. Nobody else is there. There's trash can in the corner. He's just exhausted, and he's a boxer, but he's in the ring by himself. And so he's just practicing at night. Nobody's there. There's no glory. Nobody cheering him on, and he's putting in the work that it takes to actually, someday be successful. And I waited a couple of weeks. I called him back. I said, "Hey, do you still have this?" And they had already sold it. And it took me like months to track down. Imagine Googling photo of a boxer in a ring by himself. Like there's millions of photos, but I was able to find it just by Googling it and just scrolling through Google Images, and was able to contact the photographer, following the links back and back and back until I finally found an email, and he was selling it. But at that time I was like, no, that's too expensive still. And so then a year later, my wife got it for me for my birthday, and I have it framed on my wall. So it's just kind of the cool photo to me. But it's just a random guy just in the ring boxing by himself, um, preparing, doing what it takes to finally someday be successful. And then what do I do to stay in shape? I weightlift every day. Um, I don't do a ton of cardio. I mean, bike riding, with the family, wrestling with the kids, that kind of thing. But the main thing I do is just weightlifting. All right. What are important indicators to look for with technical analysis? The I always say go do what is most common, because one of the reasons why technical analysis is useful is because people are making decisions based off of it, buying and selling decisions based off of probabilities of the price reversing or continuing. And so if you're out in no man's land using some tweaked version of some obscure indicator that nobody else has ever used because you back tested it once and it seemed to fit, means you're going to be making trading decisions that nobody else is, which means you're not going to be riding the wave that everybody else is riding. And so ironically, technical analysis is one of those things where it's like the more people who are doing it and using it, actually the better it works, because if you expect the price to bounce off of 100, then you and everybody else who has that expectation will be buying near 100, expecting that bounce, and all that buying pressure will push the price up. a little bit of a self-fulfilling prophecy. So I always say, no matter like as much as you can, lean towards and skew towards using the most common things. So even with like moving averages, stick with simple moving averages over exponential moving averages. Stick with the 50 and the 200 instead of like the 45 and the 190. So of all of the patterns, the indicators, the tools, as much as you can, just focus on learning the basics, the best, before you try getting fancy. Relationship between quantitative easing and high unemployment number. Can QE cause inflation despite poor jobs market? So quantitative easing doesn't directly impact money supply, but it provides the fuel to impact money supply. So you have to look at both. The problem is money supply has a lag in terms of when it's reported, compared to something like QE. So we can watch the Fed's balance sheet closer to real time. We can look at bank reserves, and then we can see the impact on money supply later, about a month delayed. Money supply has been expanding. So QE provides the foundation for banks to be able to expand the money supply. Um, and the expansion of the money supply is a rising tide that lifts all boats. QE also has the effect of suppressing, at least depending on where they're doing QE on the yield curve, um, at, at somewhat suppressing interest rates, which allows corporations to borrow at cheaper rates, which allows them to roll over debt, decrease their costs, and invest more into production, research, development, hiring for growth. Um, and so it is like grease that you know, greasing the line so that everything else can happen, but it's not sufficient in and of itself, if that makes sense. So it can help, but it doesn't directly cause it, and it's not 100%. Um, there were recent reports of taxes due could potentially be paid in Bitcoin. Any updates? Could this proposal be included in the Clarity Act? I haven't seen any updates on that. I think that is one of the federal government's plans on accumulating more Bitcoin. It seems as if taxes are paid in that they would not then sell the Bitcoin. It seems like they trade off. That just means that there's less total revenue coming in for using tax payments for expenses, which means the gap will be filled with borrowing. So if taxes, to the extent that taxes are paid in Bitcoin, and to the extent that the U.S. government saves that Bitcoin instead of selling it, it means that the deficit will actually get worse. I don't anticipate that it will be anything meaningful, because in order to pay your taxes in Bitcoin, A, you have to have a lot of Bitcoin already, which not that many people do. And B, you have to be willing to part with that Bitcoin. And the people who have a lot of Bitcoin are not usually willing to part with it. So I don't anticipate that payments for taxes in Bitcoin will be significant. But to the extent that it is, it does make the deficit worse as long as the government keeps the Bitcoin. All right. Let's see. Short-term risk on, long-term risk off. Do you agree? Depends on what you mean by long-term. We just have to play it by ear and see how it goes. At least for the next couple of quarters, it looks like at least my positioning is fairly bullish. Higher volatility, fairly bullish. Um, if we get to the point where it's like, hey, there's a ton of euphoria, valuations are just absolutely insane, even considering the debasement trade, the monetary devaluation, there, I mean, it just we're gonna look at the data and make up our minds as we go. But right now, I am still bullish, and at some point that will probably change. All right, let's see. Do you believe that Western provinces of Canada will break away from the rest of their nation, become part of the U.S., and if it does, how will that help our economy? I don't think it will happen. I'd be very surprised. Um, the only way that I think that would really help out the economy would be some sort of nationalization of resources, um, which could happen given everything that's been going on right now with the federal government taking stakes in private companies, which is just the death of capitalism in real time. Um, so yeah, I don't think it'll happen. In fact, uh, typically, whether you're talking about large corporations or countries, um, growth through acquisition tends to tends to be a disadvantage long term. And in fact, like splits and spinoffs tend to be very, very, very pro growth. So one example of this is like Singapore splitting off from Malaysia. Singapore went to, Singapore was a state in Malaysia, and they said, "Hey, we've got this big plan. We're just gonna have this insane growth. We want, this plan for all of Malaysia." And Malaysia's king basically just said no. And if you want to do this, you're gonna have to secede. And the king of Singapore said it was the saddest day of his life, but he said this is what we need to do. They seceded, went off on their own, implemented just basically raw like free markets, capitalism, um, just freed everything up and just exploded in growth. Um, and so if we do have some sort of secession, whether it's, a state getting kicked out of the union or a state applying for, trying to get approved to secede and coming up with some deal where they're allowed to, I think something like that would be a very interesting case study, depending on what they do with that newfound freedom of being their own nation. If they move more towards freedom, then usually that is a recipe for massive growth and massive success. All right. SGOV or money market fund. So SGOV is an ETF. It's the iShares 0 to 3 month treasury bond ETF. And apart from the few like legal distinctions in terms of the difference between a money market fund and an ETF, um, aside from that, there's really no difference here. Money market funds are regulated differently than ETFs are, but again, everything inside of it is going to be the same. Everything inside of money market funds, depending on the money market fund you choose, is going to be identical. Most regular, typical money market funds are short term; they're T-bills. You can find some that are longer than that, but for the most part, most money market funds are T-bills. The differences in regulation cause some differences to you in terms of practicality. So ETFs can be bought and sold throughout the day. Money market funds have like 1 day settlement, just like a mutual fund does. So if you need the ability to get the money out like and usable immediately, then the ETF would be the way to go. Any advice on early investing in the field of robotics? Well, if you have companies in mind, then you just treat them as if you are investing in any other company. So you look at what is the price done? What is the valuation? Who's investing in this? What is the management doing? Like you look at whatever metrics you typically use to make your investment decisions, whether it's for the long term or the short term, you're going to do that. If you don't have any ideas in mind, I would Google robotics ETFs and look at the top 7 ETFs that are, titled robotics ETFs in some way, and then look at their holdings and look at the top, 20, 30, 40 holdings of each of these. And there you'll find a good list of companies to start doing research into. If you just want to choose a robot ETF and just call it quits and call it a day, then that's fine too. But if you want to get a little bit more concentrated into some picks that you think have the best potential for the future, then that's a good place to find a good list. I would say the one filter, like just pretend that whatever companies you choose, you're not allowed to sell for 20 years. And that will prevent you from buying a company based off of unreasonable short-term expectations. And so if there's a company that just recently IPO'd and has this crazy, patent because they're going to do something, it's like, well, Maybe, but maybe not. So maybe if I'm going to take a position in this, I'm going to keep it to a really small position size because the odds that this company succeeds and grows wildly is fairly low. If they do, it'll be big, but if they don't, that's the most likely outcome. So if you can put that mental filter in place, I can't sell this company for 10, 15, 20 years, then that'll be a little bit you'll choose a little bit better metrics to rank your choices. How many hours or minutes do you spend per day at the gym? I have a gym that I've been building out in my garage over the past, I don't know, year and a half. And, so I t time-wise, it's a ton, like, it's, like, 3 hours a day, but it's not actually working out that whole time. I'll be working all on my computer out in the garage. I'll be, doing my emails and, looking at the market, doing whatever, like, I'm working out there, and then I'll do a set, and then, 5 minutes, 10 minutes will pass, and I'll go do another set. And so time wise, it's a lot, but in terms of the actual amount of working out I'm doing, it's a very like I could get if I stuck to a if I was just working out and was only resting 2 to 3 minutes in between each set, I could bust it out in 30 to 45 minutes. So it's not a ton. Can lower interest rates help lower the cost of fuel and or electric rates? Well, electricity rates are a lot more sticky because governments grant monopolies, legal monopolies. Like it's illegal for me to just start an electricity delivery company and run power lines to people and start giving them electricity. Governments grant legal monopolies to utility companies, and so you are not the customer of the utility company. Um, the utility company only cares about appeasing the government because the government is who gives them the approval or not to raise prices. So over time, they'll just do what they can to get the government to say yes to them increasing their prices because there's no competition. It's a legal monopoly. So interest rates have a lot less impact on your electricity bill. In terms of the cost of fuel, yes, but over the longer term because it's a supply and demand thing. In order to increase supply of things like gas or oil, you've got to dig, you've got to build, you've got to like it's it's a long process. You can't just I can't just go out in my backyard and start dig a little hole and start producing oil today. Um, but lower interest rates help that process get started because you can borrow and you can finance the beginning stages of that. So it can definitely help over the long term. Hershey Financial. That is the number one most common m- uh mis misreading of my channel's name is Hershey, like Hershey's chocolate. The second most common is hearsay financial. For anybody who's unaware, it's heresy, which is an old religious term that means an opinion at odds with what is generally accepted. Typically, it has religious connotations. So Galileo was deemed a heretic by the church because he said the world went around the sun and not the other way around. So I named my channel that mainly because my financial opinions, I tend to feel like they are at odds with the mainstream, what is generally accepted, but also because people who are typically labeled heretics, whether it's years, decades, or centuries later, many times they're proven to be correct, and it's just the power of who's in authority at the time that feels threatened. So they label those people heretics rather than just accepting the truth. All right. Are you eager on Japanese rates rising to be a major unwind? No. It's been signaled so far in advance, and so many people have been so like all of the money tied up in that has had so long to prepare. And after the first unexpected unwind, it's just I think it's seems like it's pretty clearly a non-issue. Has been Fed lowering rates and the Japanese central bank raising rates has been signaled so far in advance that everybody has had time to position themselves for it. Try setting up an iPad. Oh, that is I could have done that actually. That's a great idea. I didn't even think about that. I've got my iPad right over there. I could have just used that for my two-factor authentication. Thank you for that. I'll remember that next time. I did not even think of that. All right, let's see. What books would you recommend FL to learn the basics? I don't know what you mean by FL. Financial literacy, maybe? To learn the basics. So it depends on what you mean by the basics. When I think about the basics, I'm thinking about, okay, you need to make sure you are spending less than you earn. That's step number one. Number two is what to do with the difference. And typically that's just the standard order. Like, you heard Dave Ramsey: build a little emergency account, pay off your debt, then start investing. Very simple. And then when you do start investing, it's like, okay, how do I invest? What do I invest in? And typically I talk about a third in real estate, third in stocks, third in reserves. That could be broken down. Reserves is gold and Bitcoin and cash equivalents. Real estate, cash flowing single family homes. Get a property manager. Don't manage it yourself. It's an investment, not a business. And then stocks are, can be private, but mostly publicly traded stocks. That's large cap, small cap, international, domestic, speculative, all that. So in terms of books for those basics, I would say probably Dave Ramsey has the best. I mean, Morgan Housel has some really good ones. Nick, oh my gosh, I can't remember the name. Nick, I'll find it. That's gonna bother me. I'm not even gonna be able to think of anything else. Okay. So Morgan Housel has some really good books that are, for further along, like The Art of Spending Money is like, once you've built wealth, what to do with it. That's great. Nick Maggiuli. So, Nick Maggiuli has some really good books on basics. Just Keep Buying, The Wealth Ladder. The ones by Morgan Housel that are more for basics are Same as Ever. The Psychology of Money. I would start there for just the basics of financial literacy. Those three authors: Dave Ramsey, Nick Maggiuli, and Morgan Housel. How do you feel about the 24/7 trading hours proposal? I mean, it's inevitable. So I never anything that is anything that seems like it's inevitable, I usually don't have, in terms of like technological progress or innovation or movement or features, that kind of thing. I usually try to not look at those things as negatives, because there's a reason why they end up being inevitable. And so when you start to peel back the layers, it's like, okay, well, let's understand why there's not 24/7 trading already. Well, it's because when the New York Stock Exchange started, it was, paper and people in the pits, and why there's 3-day settlement forever. It took a long time for money to be cleared and delivered and physical shares to be moved from one place to another. Um, but going back to like, okay, at the end of the day, this is just, I own a piece of a business and I want to give that piece of business to you, and then you want to give me money for it. If you can give me the cash in the middle of the night, why can't I give you, the ownership of the business in the middle of the night? Like, there's no like moral reason. There's no, it's just a technological problem. For instance, the pattern day trader rule. If you are going to open and close the same position in the same day, that is called a day trade. If you do more than 3-day trades in a 5-day period, you are labeled a pattern day trader. Once you're labeled a pattern day trader, you must have over $20,000 or $25,000, one of the two, in your account, or else you will not be able to trade. They made this restriction because back when the NASDAQ went live, there were so many retail individuals with a couple $100 day trading all day long that the NASDAQ could not process all those orders that were coming in. And so they said pattern day trader rule, we're starting it up, $20,000 minimum, and that eliminated, 90% of day traders from day trading. Well, guess what? It's 2025. That restriction doesn't matter anymore. The technology is there. They could have every person in America trading all day, every day, and it'd be completely fine. But the rule is still in place because of an old technological limitation. So anytime there's something where it's like, okay, well, this is inevitable, like the technology is there, it's just an outdated rule from something of the past that exists that prevents it from happening right now. It's like, okay, yeah, of course. Like, why? Like, there's a reason. Like, ultimately, that could provide some benefits. And it's like, that's probably going to happen. If competition were allowed here and it wasn't such a legal monopoly, one of the features somebody would offer would be 24/7 trading, and then they would attract more business. So then everybody would do 24/7 trading. So I never look at things like that as inherently negative. The things I do look at as inherently negative is when somebody just decides, the bureaucrat comes in and says, no, you can't do this because I don't think it's good for people. I'm smarter than you, so I'm going to control your life. That is inherently negative. But if one exchange wants to offer 24/7 trading and the people who have investments and stocks want to do that 24/7 trading, then fine. This is all voluntary. Why not? Now, whether or not you should engage in 24/7 trading is a different story, but the ability to do it, I think, is always a plus. All right. Do you believe that both Eastern Washington and Oregon will break away from the western parts of those states and join the state of Idaho? Also, will the move to break up California succeed? No, I don't think any of those will succeed because the power structures in place exist because of the way things are currently set up, which means their incentive is to not allow those things to change. It's always possible. I just think it's very unlikely. All right. What are your thoughts on the tanker seizures? Well, I don't have a lot of thoughts. The thoughts that I do have are this smells a lot like the Middle East needing freedom 30 years ago. So, yeah, we'll see what happens. But again, this is another one of those things I was talking about earlier. It's like, why did Fort Knox not get audited? Why are the files not being released? Why is there no deregulation? Why is all these things that people were expecting, less government spending, fixing the deficit, lower taxes, like everything that people were expecting? It's like, why is it not happening? It's like, same thing here. Everybody was expecting wars to end and no new wars to start, and still waiting. All right. Peak price prediction for Bitcoin in 2026. So I don't hold these price predictions strongly. So this is just like a very loose opinion. Um, I'll give you a top end and a low end for where I would be surprised if it goes past. I would be surprised if we ever see Bitcoin below 50,000 ever again. Especially in 2026. And I would also be very surprised if we see Bitcoin over 300,000 in 2026. I know that's an insane range, so it's not helpful, but past either of those price points, I would be very surprised to see either of those. Would you include any of the pharmaceutical companies in the will not sell for 10 years portfolio? I don't think I have any pharmaceutical companies at all, maybe. Let me see. Um, I do have some trades on some pharmaceutical companies. In my long-term stock portfolio, no. The one that I've been looking at closely lately, which I don't have a position yet, is Eli Lilly, just because they have, technically speaking, they've got like a, I don't know, a 5-year long bull flag that they just broke out from. Um, so their chart looks good. They've had a bit of a retrace and then a bounce off of support, which was old resistance. So the chart looks really good. They're currently having really fantastic results with retatrutide, which is a third generation version of like Ozempic. Um, and for those of you, if you don't know how these work, GLP-1 is the molecule in your stomach that makes you feel full. That's all Ozempic is. It's just that. And so the issues with that are people can't get enough protein in, they can't get enough micronutrients in, so they lose their bone density, they lose their muscle mass. And when they do eat, they're still eating garbage. And so there's a bunch of problems that a lot of their muscle mass gets lost. So they lose weight, but it's not all fat, which is what you want to lose fat. You don't want to lose muscle and bone density. Second generation includes uh, it's called tirzepatide. It's a GIP, I believe it is. And then the third generation is retatrutide that also includes glucagon. And so it has all three of those like angles of attack, which means that just the appetite suppression is a lot lighter, but it also increases insulin sensitivity. It increases your metabolism, and so you get better effects from it without having so much appetite suppression, which means you can still get your protein in, you can still get your micronutrients in. So the recent results, they just had like an average of 71 pounds lost, 29% body weight on average lost. Um, Improvements in like knee pain from people that had knee surgery, and like just across the board, just fantastic results. And so um, it looks like they're doing the right thing there. And when you contrast it with like what Novo Nordisk has done with Ozempic, it's like Novo Nordisk has just like been crashing and burning. So that I've been looking at that. I don't have any position yet. The part of the reason is because these compounds are so easy to make. Because they're naturally occurring in the body, that it's very difficult to secure. Even if you get a patent and you get the legitimate, like, legal monopoly on it, there's still overseas uh, factories that will produce this stuff because it's just so easy to produce. And so I think that area of competition, price competition, can be a big risk factor for companies like this, but we'll see. um, Stack Bitcoin, ammo, and passports. Yep. That's a big one. If you guys haven't ever looked into your ancestry, you might be able to get multiple, like, second citizenship from like a grandparent or a parent who immigrated here. Um, Push comes to shove, you need to leave. By that time, they might not be letting citizens leave. But if you are also a citizen of another country, jurisdiction wise, it becomes a lot more difficult to force you to stay. Also, you can leave before it gets to that point if you have the option. Um, all right. Are you still holding MicroStrategy? Why or why not? I do have a trade open on MicroStrategy. I don't own shares. I have a trade on it, just for the asymmetric possibility. If this is the bottom in Bitcoin, um, then the gains that MicroStrategy could see could be significant. So I do have a trade open on them, but it's not. It's one of those like low probability but high reward if it works out type of trades. Um, let's see. Next question. Do you follow total put to call ratio and total asset of commercial bank ticker? How do you follow the QE money? Okay, so put to call ratio, yes, sometimes it's helpful, but consider the fact that for anything that gets sold, there also has to be somebody who bought that thing, and for anything that gets bought, there also has to be somebody that sold that thing. And so, if you see a lot of the put to call ratios, let's say everybody's buying calls, well, then that also means that there's an equal number of calls being sold to those people who are buying them. And so, if you are and there can be any number of reasons for that trading. So if I have shares that are way above my cost basis and I want to produce some income on that, I can sell calls. So that doesn't mean I'm bearish. And the person that is buying those calls from me, you might look at that and be like, well, they're bullish, and so are you. Well, it's like, well, not necessarily, because maybe they're buying calls as protection for being short the shares. Maybe that long call is a just a part of a spread. So they're also short a call. Now, and then that can be laddered all the way down from a bunch of people. And so now you have a bunch of calls being traded, both long and short, and let's say, comparatively no puts, but every single one of those trades has a bullish and a bearish leg built into it. And so just because you see one of these data points doesn't necessarily mean the overall market is tilted one way or the other. You have to always take into consideration, you can't see why the person is doing that trade. Even if somebody sells off a large block of shares of something, that doesn't necessarily mean that they are bearish. Maybe it just means that they're deploying that money into something else that might even be similar. Just they think has a better um, profit potential. Um, Love these live streams. Don't always make it on time. That's okay. And it's partly my problem because I don't do them at a consistent time every day. I just do them when I can fit them in because I figure it's better than nothing. And so you can always watch them live. And the nice thing is, you guys probably know this, but I just found this out. When you're watching a live stream as a replay, you can click on the button to do the chat replay while the video plays. That way you can see the questions pop up in real time as I'm going through them. You guys probably already know that already. I just live streams are kind of new to me. All right, let's see. Lowering rates just makes monetary policy less restrictive, but does this not QE make this officially an easing cycle? Yes. So these terms are kind of designed in a way to obscure what's really going on. Um, at the end of the day, what's happening is debt monetization. So debt monetization is the process by which the central banks purchase debt that the central government has issued. So the central bank creates new currency and uses that to loan to the central government. Now it's indirect because they do it off of the market, but the effect is the exact same. It doesn't matter that it's indirect, that it goes through like a primary dealer first or whatever. So debt monetization is central bank prints money, uses that, and loans that to the central government. That's debt monetization. So then the government owes money back to the central bank. And then when it gets paid back, usually they just rolled over. If the amount that they're monetizing is increasing, so they're adding assets, they're adding treasuries debt to their balance sheet, that's easing because now there's more newly created money that is entering the financial system. Whether they do that by buying short-term debt, long-term debt, all the above, doesn't matter. Still debt monetization, still easing, still new money coming into the system. And the opposite is true as well. QT is when they're letting assets bleed off of their balance sheet, that sucks liquidity out of the system. QT is what they've been doing for the past couple of years. They've ended that now and they've reversed course. So it is officially easing now, regardless of the reason why they say they're doing it. And they say they're doing it to manage reserve balances, and that might be completely true. Still easing. All right. I converted 20% into physical gold. I'm done playing with Monopoly money. My personal portfolio allocation is, and this is standard, this is not like me trying to play it safe, is 30% in real estate, and that's cash flowing single family homes with a property manager in states that are landlord friendly and have good rent to purchase ratios. 30% in stocks, and that's like, you know, all sorts of stocks. And then 30% in reserves. And of that, it's 20% gold, 5% Bitcoin, 5% cash and cash equivalents. If you're doing the math, there's 10% left over. I use that for speculative trading, asymmetric trades, hedging, options, things like that. Um, the reason why is because that gives you dry powder, so that you don't have to become a forced seller when everything crashes, and it allows you to be a buyer when everybody else is fire selling. So, gold is a savings account for thousands of years. It's maintained its purchasing power. I expect it will continue to do so into the future. And so I use that as my reserves. I use that as my savings account. You can think of it similar to like a 60-40 stock portfolio. The purpose of that would be if stocks drop, you can sell your treasuries and buy stocks, because they're supposed to operate as reserves. It just doesn't do its job very well. The real estate portion gives you tax benefits, gives you leverage benefits that you can't get across the rest of your portfolio. And I do that from an initial allocation standpoint, as well as dollar cost averaging when I get income to invest. Just insane we even have such drugs when parts of the world are starving. At least make ones that cut alcohol. Okay, so a couple things about this. So number one, there are quite a few people who have gone on semaglutide, tirzepatide, or retatrutide, or other experimental ones, who have reported that their alcoholic addiction tendencies decrease or even completely are eliminated. Um, or some just report, not having an alcoholic addiction problem to begin with, but they report like, I don't feel like drinking anymore, so my alcohol consumption has gone way down. So it's actually, these GLP-1 medications are helping people cut out alcohol, which is pretty clear these days. Alcohol is very, very unhealthy. So that is one thing. The second thing is that this has been true for decades, by the way. This is not just true today. This has been true for a couple of decades now. The world, we don't actually struggle with a lack of food or a hunger problem. I should rephrase that. We don't struggle with a lack of food problem. The places where there are still people who their biggest concern is that they are hungry, that they, food insecurity, it's an infrastructure issue. We have plenty of food that goes to waste very relatively nearby places that need the food. It's an infrastructure problem because the governments that are in place either have destroyed the infrastructure or don't allow it to get built because of the corruption, and they just, take the money and whatever. If the infrastructure, the roads, the electricity for refrigerated cars and all that were allowed to be built, and there's a profit incentive to do so, like food companies, like Cisco and whatever, like there's more people who could buy their food. We'd like to deliver it to them. There are governmental issues preventing the infrastructure from being put in place that prevent the food from getting where it needs to go. And so the food just goes to waste. Globally, there's more than enough food. And that's why we get to the third thing when I said we have very few hungry people even left over in the world today. Just this happened recently, but now we have more children who struggle with obesity than struggle with malnourishment globally. So that's a very good problem to have. Obviously, that's still a problem because, obesity, especially as a child, like that is a problem. But it's still, I think, a movement in the right direction where it's like, there might be long-term health consequences from, being obese your entire life. But the consequences of malnourishment are you just die. So being sick at an old age, I think, is better than being dead at a young age. So anyway, we are still seeing good progress on fronts like that. And so I think it's important to know, what the facts are rather than feeling like everything is doomed. Okay. What do you think about space stocks? So far I have stayed away. If SpaceX IPOs, I don't like investing in IPOs because typically what happens is you get a bunch of hype at the beginning, the stock pumps, and over the following year, all the insiders, all the people who've been there forever, just as the lockup periods end, people who got in on the IPO, whatever, like you get a lot of selling that ends up crushing the price. And then usually after about a year, then it's like you're able to reconsider and be like, okay, now is that a reasonable valuation for what we can expect this company to do in the future? That's not always the case because sometimes they just IPO and go straight to the moon. And with SpaceX, maybe they'll go straight to Mars. But generally, I tend to stay away from IPOs. Space stocks in general, I've tended to stay away from as well because a lot of them, like Richard Branson's, has been a similar type of story where kind of a pop and then immediate just collapse. Um, and I haven't looked into the space super closely, so I don't have any at this point. Is there more realistic risk to getting GLD than physical gold? Yes, in the case of a complete global collapse of everything. Barring that, GLD will serve you fine. Um, GLD has the audits, they have the gold, it's allocated in the vaults. So the situation which that bites you in the butt is where like we get a complete societal breakdown, nuclear, apocalypse. Like then it's like, okay, well, you want the gold physically for sure. But you have to consider the trade-offs and the costs for everything. So taking delivery of physical gold is expensive. You're going to pay way more per ounce. Then if you store it yourself in a vault, it's got a negative yield because you have to pay for the storage. So something like GLD is like it does. There's always a trade-off in risks. So it gets rid of the risk of somebody finding out that you have it and then coming in and stealing it from you when you're not home or killing you to steal it. It eliminates the risk of the immediate like baked in risk of having to pay for storage. I mean, there is a small fee on GLD, but it's nowhere near, the fee that you pay to actually store it yourself usually. Um, and then if you do use GLD, then you take on the additional risk of the counterparty risk. Like as far as we know, as far as we have the ability to tell, yes, all the gold is there, but if push comes to shove, the world is collapsing, you're not going to get any of it. So as long as you don't have to pick one, like you can have it spread out. You can have some physical, some in GLD, some in storage, some being leased out. So you can spread it out. You don't have to have it all in one place. What percent of silver do you hold and when will you sell or how long will you hold? I don't consider silver as like a part of my like I talked about, like I've got real estate, stocks, gold, Bitcoin, and cash. Like those are like the 5 pillars of my portfolio. Silver is not included in that. I do have a long-term position in silver, but I don't have a current trade open on silver in terms of short term. I did recently. We just closed it out. This was one of the recent trades in the in my trading program. It was on SLV. We got in at man. I believe SLV was around, I could be wrong on this. I think it was at around 32 when we got on a trade because it was earlier this year. And then we got out when it was around 45, if I remember correctly. And it was an option trade, so it was a significant gain. I don't have any short-term trades on silver. I am actively buying right now, but I'm not, especially in the short term, super bullish. Like if it just spiked right here to like 100 or something, I'd probably sell it all. I'd have to see what caused it, but if it's just the current run up, the euphoria, that type of thing, then I'd probably dump it all. What do you think of REITs? I think they're fine if it's your way of saving up to be able to purchase real property. But you don't get any of the leverage advantages. Like you can't take out a 30-year mortgage on a REIT, a fixed rate mortgage on a REIT. You don't get any of the tax advantages. Like you can't do a cost segregation study and bonus depreciation on a REIT. And because the massive amounts of capital in public markets, most of the return, that you can get from individual properties is just arbitrage way through price run up. And so you can get much better cash on cash returns by buying individual properties. Um, so I think they're fine if it's like, hey, I got to put, a couple $100 away a month to be able to get to the point where I can afford a down payment on a individual property. But I personally wouldn't use them for like my entire real estate allocation for a larger portfolio. All right, I'm going to do one more question here. Can you comment on Nvidia, Netflix, Duolingo, Broadcom, and VRT for lump sum investing? I'll be selling all my Carvana shares. I'm considering lump sum investing all the money, or should I wait for better deals? Um, I think it would depend on your reason for buying those specific stocks. And so I'm treating this as if you've already sold the Carvana and now you're sitting on the cash. The one thing that I would say is, you're going to feel like the cash is burning a hole in your pocket. You're going to feel a sense of fear and panic of like, if I don't deploy this immediately, then I'm just losing out on potential gains. So that's one way you can let fear take over in this kind of decision making process. Now, the other side of it could be like you're afraid everything's about to collapse, and so you're just going to sit in cash waiting for the crash. Um, Now, since you have Carvana right now, and I'm assuming that's like 100% of your portfolio based on what you just said, um, you're probably not the type of person that was in cash at the beginning of this year, saw the April crash, still didn't buy, and are now still sitting on cash. That type of person is never going to buy. And so if you're like, yep, that was me, it's like, well, then it's better to lump sum or just dollar cost average in, because even if the market's about to crash right now, dollar cost averaging in over time, you're still going to be better off because at least you're in the market. Um, a lot of people miss that first crash and they're like, oh, I'll just get the next one. It's like, well, what makes you think you're going to get the next one? It's never going to crash enough, and you're going to miss the next one too. And by the way, even at the bottom of the next crash, it's still going to be higher than where you're currently able to invest right now, most likely, just statistically. So you ought to make sure you know yourself and you're looking at your motivation, so you know whether you have fear dictating or any emotion dictating your investment decisions. So that's number one. Number two is recognize that there's always another opportunity. There's As long as humans are alive, there's no such thing as all the opportunities to make money going away. It's like there's always another opportunity to buy something. There's always another opportunity to short something. There's always a long, there's always a short. So even if you make a mistake and miss out on something right now, that's okay. There's always going to be another opportunity. So you don't ever have to have that fear of missing out, because it's not possible to miss out, because there's always something else coming along down the road. That gives you freedom to analyze each opportunity without a sense of urgency. So look at your time frame. Are you doing this for a couple of months? You're trading based off of the charts. Are you doing this for a couple of years or a couple of decades? Um, and then look at how you are making your investment decisions. Are you making it based off of the charts? Are you making your investment decisions based off of the fundamentals? You're looking at the management. You're trying to be the next Warren Buffett. Like whatever it is that is your strategy, that's completely fine. Just have a strategy, and then also last, have an exit before you enter. Even Warren Buffett does this. He doesn't want to sell, but sometimes he sells. Sometimes he sells his bank stocks. Sometimes he sells his Apple stock. Sometimes he sells his Chinese stocks, because the conditions that got him to invest have changed, whether it's management, whether it's the balance sheet, whether it's the income, whatever it is, whether it's the valuation just got into bubble territory. And he's like, this stock isn't worth this price. The value is lower than the current price. I'm going to get out. Whatever it is, there are criteria that you will have, whether you're a short-term trader or a long-term investor, that will cause you to exit. And you need to know what your exit is before you enter. If you don't know what your plan to leave is before you get in, then you won't know when to get out once you have gotten in, because now you've got emotion on the line, because you've got real money on the line. and you'll make the mistake of either holding on too long or not long enough. So always have your exit plan before you enter. And that will give you an idea of whether you should buy right now. Because if you think, okay, well, I'm going to sell Netflix once it has a price to earnings ratio of, um, let's say 40, well, then you look at it, you're like, well, it's trading at 39 right now. So there's no profit opportunity there. Maybe I will wait to buy it until it has a PE ratio of 20. And that way, I'll sell it once it's 40. Might be a dumb example. I'm just saying when you know what will cause you to exit, that'll help you make your decision on where to enter. So, and then finally, statistically, lump sum investing works out better than dollar cost averaging about 70% of the time, because usually markets go up. And so usually if you invest everything once you have the cash, you're going to do better because you're investing it at a lower price. About 30% of the time, you do better by dollar cost averaging because sometimes markets go down. The difference between those two is actually pretty small. The difference between the lump sum investor and the dollar cost averager is pretty small. And so if you want to play it safe and dollar cost average, statistically, you'll usually end up with a little bit less wealth over the long term because you bought in. Most likely you'll be buying in at an average higher cost, but it is a little bit on the safer side because if it does drop, you get to buy at a lower price and then you do better. So that's what the statistics say. All right, guys, that's it. Thanks for hanging on. It's been good. Good questions this time. Appreciate you guys watching and all the good questions. I'll try and do this again on probably not tomorrow, maybe Thursday. So I'll see you in the next one.